Depression from AI spending, you're looking at a potential 50% drawdown from current levels. Think I'm being dramatic? Let's look at history. In the 2000 tech crash, Cisco Systems traded at 80 times earnings. Investors believed Cisco was the backbone of the internet, which it was. But when growth slowed and margins compressed, the stock lost 90% of its value. Not because Cisco was a bad company, because it was a great company priced for perfection that couldn't deliver perfection. Google won't drop 90%, but a 30 to 50% correction? That's not speculation. That's arithmetic when a growth stock gets repriced as a mature business. Consider the parallel with other tech giants who face similar transitions. Microsoft traded at 60 times earnings during the dot-com bubble. When reality set in, the stock went sideways for 15 years. Not because Microsoft was failing, but because it took that long for earnings to grow into the valuation. Shareholders who bought at peak multiples in 2000 didn't break even until 2016. That's a generation of capital locked up, waiting for fundamentals to catch up to expectations. Amazon provides another instructive example. Between 2018 and 2022, the stock went essentially nowhere, despite revenue growing 30% annually. Why? Because the P/E ratio compressed from 60 times down to 40 times as investors realized that scale alone doesn't guarantee pricing power. The business was healthy, the valuation was the problem, and this brings us to what Bill Ackman understands that most investors don't. The best time to sell isn't when everyone else is panicking. It's when you're still profitable and can redeploy capital into better opportunities. Ackman doesn't sell because he thinks Google will go bankrupt. He sells because he sees better risk-adjusted returns elsewhere. Let me walk you through his playbook, because this is where the story gets really instructive. In February 2020, Ackman watched COVID-19 spreading across the globe while markets were still near all-time highs. He didn't panic sell his portfolio. Instead, he spent $27 million on credit default swaps, essentially insurance contracts that pay out when credit markets deteriorate. Within 4 weeks, as panic peaked and credit spreads exploded, those contracts were worth $2.6 billion, a near 100-fold return in 1 month. But here's the crucial part that most people miss. Ackman didn't just make money on the crash. He used those profits to buy stocks at the absolute bottom. He loaded up on companies like Hilton, Starbucks, and Lowe's when they were trading at Depression-era valuations. Today, those positions have generated billions more in profits as those companies recovered. That's the Ackman playbook. Sell your winners before the crowd realizes they are overvalued. Raise cash. Wait for the panic. Then deploy into distressed assets when nobody else has the stomach to buy. And right now, we're seeing the early stages of that playbook unfold again. He's trimming Google not because he needs the money, but because he's preparing for what comes next. He's raising dry powder for when the market gives him better opportunities. Think about the opportunity cost of holding Google at these valuations. Treasury bills are currently yielding around 4% with zero risk. That means the U.S. government will pay you 4 cents on every dollar just to hold their debt for a year. Meanwhile, Google's earnings yield, the inverse of its P/E ratio, is roughly 3%. You're taking on equity risk, regulatory risk, technological disruption risk, and execution risk to earn 1% less than a risk-free treasury bill. Does that make sense to you? This is what Ackman is calculating when he makes these decisions. It's not emotional. It's not based on whether he likes or dislikes the company. It's pure math. If I can earn 4% risk-free or 3% with massive downside risk, which would I choose? The answer is obvious when you strip away the hype and focus on the numbers. And this leads us to the broader lesson that applies to anyone managing their own investments. When activist investors like Ackman start selling their favorite stocks, you need to pay attention. Not because they're smarter than you, though they probably are, but because they're playing a different game with different information and different risk tolerance. Ackman doesn't day trade. He doesn't flip stocks for quick profits. His average holding period is measured in years, sometimes decades. When someone with that kind of patience and conviction starts trimming a position they have publicly championed, it means something fundamental has changed in their analysis.